You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to the Investor Way. It's the 25th of March 2024 with me, Sam Ball, and I'm joined by my co-host John McEwen. And in this week's episode, we'll be discussing Prudential, Direct Line, Next, Trustpilot, Spoons, and our US company of the week is Guess. John, do you want to start us off with Prudential?
Yeah, so we'll start off with the stodgier stocks first. Prudential, so we've covered it before. It's the UK-based Asian-focused insurance company. Had its full year results out last week, with the group reporting new business volumes, annual premium equivalent sales of $5.9 billion, which was up 37%. New business margins rose from 50% to 53%, which helped new business profit rise 45%, ignoring the effects of exchange rate, to $3.1 billion. And both measures were better than expected. Underlying operating profit rose by 8% to $2.9 billion. And Eastspring, which is Prudential's asset management arm, saw net inflows of $5.5 billion, and funds under management rose by 7% to $237 billion. Sales growth momentum has continued into 2024, and management is confident that it can deliver a compound annual growth in new business profit of between 15 and 20% over 2022 to 2027. The board proposed an interim dividend of 14.21 cents per share, and that takes the full year total to 20.47 cents, which is up 9%. In terms of valuation, Prudential has a market cap of £21 billion and trades at 9.5 times forward earnings, with a prospective dividend yield of 2.3%. I thought this was a decent set of results as China emerges from the COVID era, and it was encouraging to see the shift back towards the higher margin health and protection businesses. I think also it does seem logical for the business to continue to invest in itself, particularly the $1 billion that's been allocated for the technology and platforms to improve the customer experience. It is one stock that I do have in my legacy portfolio, and I think, as we've commented before, when we do cover these big insurers, it can be tricky to understand. I think it's much more orientated towards growth now, with the goals of between 15 and 20% over the next few years, and focusing on the emerging markets, China, Africa, India, having shed the M&G and Jackson, which was the US business. I certainly don't think it looks expensive at 9.5 times forward earnings. However, there is always a lot of uncertainty in the markets that it operates in, but I'm quite happy continuing to hold it. Sam, what are your thoughts on these results from Prudential?
I thought they were fine. Obviously, the underlying operating profit's only up 8% compared to 37% for sales, but that's just insurance premiums have had to go up to underwrite them profitably. And we'll see the same thing with Direct Line in a second without spoiling it, but it's kind of what you'd expect. I agree the valuation's pretty fair. I don't think there's going to be loads of growth in it, but at under 10 times earnings, you wouldn't really expect that. So it's not something that would interest me, but I think at 9.5 times earnings, you could probably do a lot worse.
Yeah. Do you think it's got more appeal compared with some of the other insurers with the focus on the emerging markets?
Possibly. I think if you wanted to add more emerging market exposure to your portfolio, I mean, there's a few good stocks listed on the FTSE, not just insurers. I guess if you're looking to diversify, it would possibly give it an edge for some investors.
Shall we move on to Direct Line?
Yes, so Direct Line, our second insurer of the week, have come out with full year results, and they've reported a 27.1% rise in gross written premiums and associate fees, which have increased to 3.1 billion, and that's largely driven by price increases. The net insurance margin was minus 8.3%, and there was an operating loss of 189.5 million. This was pretty much entirely due to the motor division, which had a big loss and was offset partly by profit in other areas. In-force policies were broadly flat at 9.4 million, despite losing 383,000 own brand motor customers. The solvency capital ratio which is a measure of balance sheet strength, improved to 201%, benefiting from the sale of its brokered commercial business. And they've proposed a dividend of 4p a share, but that's been warned by the board that it's not necessarily a return to the regular dividends that they previously enjoyed. The group's aiming to deliver a net insurance margin of 13% in 2026 and 100 million of cost savings by the end of 2025. So the results are poorer than Prudential's. However, Direct Line were slower to raise prices than most of their competitors, so it is taking longer for that to flow through. The results were slightly overshadowed by a takeover offer they've been under from a Belgian insurer, Ageas, probably Ageas. And they'd previously rejected a couple of proposed deals, and Ageas were trying to pull together a third bid. However, they've come out and said they don't intend to make a third offer, and the previous two were rejected because the board felt that the two offers undervalued future prospects, and the shares fell 12.5% following the announcement of that. In terms of valuation, the business trades at a forward PE ratio of 12.7, and that compares to a 10-year average of 10.9. And the prospective yield over the next 12 months is 7.7% compared to 8.1% for the 10-year average. I think these results are okay. I mean, I know there is a loss, but they did raise prices later than a lot of competitors. Again, although it's a bit more expensive than Prudential at 12.7 times forward PE, I guess that is on what are effectively the lowered earnings that it's got at present. So in terms of normalized earnings, it's probably an okay valuation. I think I would have the same issue with either. I just wouldn't want an insurance company. I do find them too hard to value. But yeah, I thought these results were fine given the circumstances. What about you, John?
Similar, I think. Yeah, I'd be happy sticking with Prudential. I think there's probably more growth ahead of it as well, just with the markets that it's operating in and with the growing populations there, being able to sell them, life insurance policies, etc. I don't really have much interest in Direct Line, to be honest.
Right, should we move on to our next business then?
Yes, so it is a favourite of the show, but despite that, neither of us own it. It's Next, which is the clothes and home retailer. They had their full year results out last week, with Next total full year sales rising 5.9% to £5.8 billion. And this was largely due to a 5% increase in online sales to £3.2 billion, whilst sales from physical stores were flat at £1.9 billion. Sales from abroad were up 17%, with net margins improving by 4.4 percentage points to 13%. The smaller finance division, which is Next credit card business, rose 7%, and the higher revenues meant that pre-tax profit rose 5% to £918 million, as improvements in the online and retail divisions more than offset a 4% decline in financial profitability. Free cash flow, including lease-related payments, was £750 million, and net debt, including leases, fell by 4.6% to £1.7 billion. A final dividend of 141 pence per share has been announced, bringing the year's total to 207p a share, and share buybacks for the year totaled £177.3 million. Next expects full year sales to increase by 2.5% for the year ahead, and pre-tax profits to increase to £960 million. The shares rose 4.6% in early trading. In terms of valuation, Next has a market cap of £11.7 billion and trades at 14 times forward earnings. The group plans to return £546 million to shareholders through dividends and share buybacks in the upcoming financial year. I thought these results were pretty good in the current climate, as real wage growth continues to grow and overall inflation falls. This should benefit Next, and it's not expensive, as we always comment, and it is continuing to deliver. I mean, whilst we've always appreciated the quality, I think both of us have probably just expected it to stop and just felt that we were maybe looking at it too late. The best days had we been peak Next, but I think we really continue to be proved wrong, and it is a testament to the business's quality. Sam, what are your thoughts on these latest results and the current valuation?
I thought they were pretty good. I know 5.9% sales growth they've not, absolutely shot it out the park. But that is in a year where we've basically had a cost of living crisis. So I think those results could have been a lot worse. So I think given the economic climate and the year we've had, I actually think it's a pretty good set of results. And it is a testament to how well run the business is. I think as well, without punishing ourselves too much, commenting on what you've said, I mean, 54% of the sales are now online. That's always been exceptional, especially compared to other British retailers and even some of the higher quality retailers that we've covered. I can't really think of another business that has that much of an online presence as Next in terms of the proportion of total sales. And then as well, sales abroad were up 17%, which I wasn't really aware that Next was operating overseas. And the margins are up 4.4% to 13%. So again, we've talked about this for years now. We've never really talked about overseas growth. I don't know if it's something that will be a significant driver of growth going forward, but we see so many sort of British companies and they try and crack overseas markets and it just ends up draining money. Yes, 17% growth isn't amazing given it's probably off a very small base, but when it's doing it with net profit margins, that is something you rarely see. And again, I think it's just a testament to how good the business is. And then the valuation at 14 times earnings, I think given the quality of the business, the history of the results it's been putting up, it does just deliver year after year. I don't think you can. I think if anything, it's probably, it could arguably trade at a higher valuation. But yeah, really, really good business. I wish I'd bought it when we first started covering it, really, because I do really like it, and it just continues to deliver.
Yeah, no, completely agree. Completely agree. Okay, on to a new company then.
Yes,
Well,
so
a new company for the show.
Yes, so this is a debut, so it's Trustpilot. So I wasn't sure why we never covered it before. So it's listed on the FTSE 250. It's pretty small with a market cap of 738 million. The shares are up 113% in the last year, so I don't know what the smallest market cap you'd need to get into the FTSE 250. But I wonder if this is the first time we've seen it, because on the back of that 113% growth, it's now big enough for the FTSE 250. Because I think it's a kind of business where if I'd seen it, I would have covered it previously. So that's my guess. But anyway, we're covering them now. And Trustpilot have come out with their full year results for the year ended 31 December 2023. And all these figures are in dollars. Revenue is up 18% year over year to 176 million. Annual recurring revenue was up 22% year over year to 197 million. Bookings were up 18% year over year to 195 million. They've said the focus on efficient growth helped deliver strong operating leverage in the year, with adjusted EBITDA of 16 million, and that compares to a 4 million loss last year, and a reported profit after tax of 7 million compared to a 15 million loss last year. The last 12 months net dollar retention rate is 99%. They had 14 million of positive adjusted free cash flow, and that compares to a 13 million outflow last year. And they had a closing net cash position of $91 million. They've commenced a share buyback program of about 25 million in January 2024. The monthly unique users was up 30% to over 57 million, and the total cumulative reviews was up 25% to 267 million, with 54 million new reviews. The number of reviewed domains is up 22% to 1.1 million. So before we break these down a little bit more, I did wonder with Trustpilot, how exactly do they make their money? Because they are just a free review platform. And although it's free for the reviewers, for businesses, it says on the website, we have a free product and we have a paid product. For free, any business can invite its customers to leave a review. They can reply to the reviews and they can learn from what their customers think about them. For the paid services, we allow businesses to show the reviews on their website where they can hopefully use them to win more business. Businesses can automate a lot of manual processes, it saves them costs. And then finally, we're offering them more sophisticated insights into their customers that they can use to take action and improve their business. I actually think that's a decent business model. I mean, in terms of just paying to have the reviews on your website, I'm not sure how valuable that is, but in terms of the data they'll have on the customers, that probably is quite valuable. So I think there probably is quite a bit of growth potential. If we go into other key metrics, the operating loss in terms of GAAP figures was 618,000, and that compares to a 15 million loss or 16 million loss a year ago. The net cash inflow from operating activities was 21 million, and that compares to a 2.7 million outflow a year ago. And adjusted free cash flow was almost 14 million, and that compares to a 13 million outflow a year ago. And the earnings per share was 1.7 cents compared to a 3.5 cent outflow a year ago. So I think that's probably behind the rise in share price over the last year, and that they do seem to have turned a corner. I'm guessing it was reflected in the interim results as well, and that's why they've done so well. But it seems to have turned a corner where it's actually heading towards profitability now. I think it's probably the kind of business where, unless they pump all their money into advertising as well, it's probably going to stay pretty profitable, and it's probably going to have pretty good margins at some point. If we break it down by regional performance, the UK generated bookings of 77 million, and that was up 17% in constant currency. And in the UK, they've said they continue to see net dollar retention rates above the group average and a further improvement in profitability. For Europe and rest of the world, that was 76.3 million, so pretty much the same as the UK, and that was up 18% in constant currency. And they've said their key European markets include Germany, Netherlands, France, and Italy. And North America generated bookings of 40.9 million, which is smaller than the 76 and 77 million of Europe and rest of the world and UK, but still pretty decent. And that was up 12% on a reported basis. They've said their go-to market strategy in the US focuses on a high customer lifetime value, vertical market segments such as financial services, healthcare, and legal services. The strategy has supported an acceleration in bookings growth and improved customer retention through the period. We achieved greater sales effectiveness, shorter sales cycles, and increased profitability. If we go to the financials since they listed, so they only listed in like 2019. For the year ended December 2020, revenue was 101 million, and then that's grown each year to 131, 148, and now 176 million. Operating profit in terms of the statutory results, that's in 2020 was a loss of 9 million on 102 million nearly. 2021 was a loss of 24 million on 131. 2022 was a loss of 16 million on 149, and 2023 was a loss of just 0.62 million on 176. So to me, it does look like a business that's turning a corner. In terms of the valuation, the business trades at a P/E ratio of 142. However, those earnings are only just starting to come through. It's really hard because you'd probably have to have a go at estimating what you think the margins could be. I don't really know, but I don't know if it'd be quite as good, but it seems like the kind of business I could see having margins similar to sort of Rightmove or Auto Trader. Maybe not as good as Rightmove, but if it were to get there, it probably wouldn't matter that it's trading at a multiple of like 4 times revenue, because if the margins were so high, it could still be a relatively low PE ratio. I think this looks like a really interesting business. For me, I'd probably want to take another look at it in a year's time when it's actually got a year of hopefully decent earnings. It's got a PE ratio that I can sort of understand. You can see that growth trend continuing. Hopefully the revenue in all segments is still growing. I think it's probably a business with a lot of optionality. There's probably stuff that we won't have thought of right now and they haven't thought of in terms of monetizing that data, because I just think it will be so valuable. So it is a business that I think looks really, really interesting. But I think at the minute, for me, it's probably just a bit too soon to be able to have a go at valuing it. I think it would just be a bit too speculative for me. But it looks like if we come back in a year or two, it could be a very, very good business potentially, and one that I'd potentially be quite interested in owning. John, what about you?
Yeah, no, similarly, I think it's a very interesting business. I probably wouldn't be buying anything at this stage, but I think in the future, and if they can monetize all of those different channels and make use of that data, it could, like you say, be sort of have Rightmove like margins and have a lot of scope for growth. And then particularly if it grew sales in North America as well. I'm not sure about all of the competitors that are there in North America that operate like Trustpilot, but that'll be something else that needs to do a bit more research into. It's interesting because it floated. I think it was nearly £1 billion when it floated, and it's come back some way. And I think after 2021 had a bit of a rocky time, but now you're beginning to see, although it is still early, the signs of where it could be going and not have a ridiculous valuation.
Oh, yeah. I wonder if it dropped out of the FTSE 250 and then it's come back in, and that's why we missed it, because it did float before we started doing the show.
Yeah.
Yeah, so it looks like it was 2019, floated about £2.70 or something, shot up to over £4 a share. It's then dropped below £1 for a while, and then presumably dropped out of the FTSE 250, and then now in the last year it started climbing back up.
Mm,
I think an issue for me is it's if you're going to try and value it now, you are basically guessing at what you think the margins could be. And it's
yeah.
easy for us to sit here and be like, well, they could be very high. But if you start doing valuations, we're assuming right move like margins. It's really difficult to get to that, even for a business that does have that potential. And
Yeah.
then
Yeah.
certainly in terms of like the UK, I can't really think of a comparable business. So it's not like you can look at a competitor and say, well, actually, if it had these margins. So I just think it's probably I think it's a bit too early for me, but it's definitely a business I'd like to take another look at in a year's time.
Yeah. And a good example of a UK tech business,
Yeah, it is.
or
Yeah,
one of those rare things.
it is. Yeah.
Fine.
Should we move on to spoons then?
Yes. So quite a mature business that has been struggling, I was going to say of late, but really it's been over the last few years since COVID. So it's the UK's largest pub chain. They had their half year results out with Spoons reporting first half revenue of £991 million, reflecting like for like growth of 9.9%. Underlying operating profit grew by 81% to £67.7 million, helped by limited growth in operating costs, which expanded by just 5.1%. Free cash flow swung from 166 million to an outflow of 6.1 million pounds. That was impacted by the timing of payments to suppliers and the tax office. Net debt, including lease liabilities, stood at 1.1 billion pounds, and like-for-like sales growth in the first 7 weeks to the second half has slowed by 5.8%. And the shares were down nearly 7% in early trading. In terms of valuation, Wetherspoons has a market cap of £938 million and trades at 17 times forward earnings, and it's not currently paying a dividend. I think the results were encouraging, certainly to the half year. I think the last bit, a little bit of a dip there. And it's obviously great to see that margins are continuing to recover, but it is an incredibly difficult sector at the best of times, and input costs with rising wages and a huge pile of debt of over £1 billion would ultimately just put me off Wetherspoons altogether. I think it is well run, and Tim Martin is a great chief executive, but it's just had such a difficult time. And I suppose, as he always points out, they are at a disadvantage when you compare, operating, I suppose, at the lower end, but also with the tax on, or the lack of tax, if you're buying booze from a supermarket, which always is going to put pubs at a disadvantage. So it's tricky, and it's not one for me, but yeah, sorry to say.
I'd broadly echo that. I think for me, I wouldn't be too concerned about the debt, just because a lot of the properties are worth much higher values than what's in the accounts. So if you were to include that, it's probably nowhere near as bad. And if anything, I think if it were to sell off everything, it would probably be quite a substantial return going to shareholders. I think from previous times we've looked at it. I mean, these figures are actually, I think, pretty decent, 9.9% growth. I think it's probably been helped by the cost of living crisis, because I think a lot of people have probably moved towards spoons because they have done a good job at not raising the prices too much. And when you go in there, it is still just very, very cheap. I think 17 times earnings seems quite expensive. I don't think it's a business going to have loads of growth. I think the only reason I can think that it might be trading at 17 times earnings, especially when the 10-year average is 20, which again just seems really high for the business. I think it's because those properties are worth more than the accounts figures. And if that value will be unlocked and the property sold, I think that's been taken into consideration. Now, the issue I would have is, JD Wetherspoon has been around for years. They are a pub company. They're going to continue to operate as a pub company. I think if you're buying shares today, you probably need to do so with the assumption that that value on the balance sheet is probably never actually going to be unlocked. So would I pay, double what a business might be worth in terms of how much it's earning because the properties are worth more, but those properties are potentially never going to be sold? I don't think I would. So yeah, so for me, I just wouldn't ever be interested in it at those prices. Even if it was cut in half, I think it's such a competitive industry. And although it's a really good operator, it's a good operator in a really poor industry, I think. I like it as a consumer, but As an investor, I would never touch it.
Fine. Okay. On to a second debut on the show.
Yes, so it's the US company Guess, which is they do like the fashion stuff, don't they? So you can tell we're quite hot
The
on
fashion stuff.
these things. It's like designer fashion, isn't it?
Yeah.
They have come out with their full year results. So for the 2024 fiscal year, the company recorded adjusted net earnings of $174 million, and all these figures are in dollars, which was an 8% increase from 2023. In terms of net revenue, the revenue increased 3% to 2.78 billion, and that was also 3% in constant currency. In Europe, revenues increased 7%, and retail comparable sales, including e-commerce, increased 9%. They said the inclusion of e-commerce sales negatively impacted the retail comparable sales by 2%. America's retail revenues decreased 6% in dollars and 7% in constant currency, and retail comparable sales, including e-commerce, decreased 5% in dollars and 6% in constant currency. They said the inclusion of e-commerce sales had a minimal impact on the retail comparable sales percentage in both the US dollars and constant currency. America's wholesale revenues decreased 3% in dollars and 6% in constant currency. Asia revenue increased 16% in dollars and 18% in constant currency. Retail comparable sales, including e-commerce, decreased 2% in dollars and increased 1% in constant currency. The inclusion of e-commerce sales positively impacted the retail comparable sales by 2% in both US dollars and constant currency, and licensing revenues increased 9%. They said that adjusted earnings for the year from operations decreased 3% to 255 million, and adjusted operating margins decreased 0.6% to 9.2%. And that was driven primarily by higher expenses, including higher store costs and performance-based compensation, unfavorable currency impact, and lower government subsidies, partially offset by higher initial markups and the favorable impact of business mix and higher revenues. Operating margin for the Europe segment remained relatively flat at 11.6%, driven primarily by higher initial markups and the favorable impact of higher revenues, offset by the unfavorable impact of currency, higher expenses, and lower government subsidies. Operating margin for the Americas retail decreased 3.5% to 8%, and that was driven primarily by the unfavorable impact from lower revenues, higher expenses, and higher markdowns. Operating margin for the company's Americas wholesale segment increased 4.8% to 27.2%, driven primarily by higher product margin, partially offset by higher expenses. Operating margin for the Asia segment increased 4.9% to 2.9% from negative 2%, driven primarily by the favorable impact of higher revenues and partially offset by higher expenses. And the operating margin for licensing increased 4.2% to 93.3%, mainly due to the favorable impact of lower expenses and higher royalties. In terms of the valuation, business actually only trades at a PE ratio of 11, and the forward dividend yield is 3.92%. I thought these results were pretty lackluster, really. If we compare them to what we've been used to seeing from Louis Vuitton, they're pretty poor. I think the 9% increase in licensing is encouraging, especially when you see those 93% margins, because that is just pure profit. So the more they can license, really, the better. I think it's slightly concerning that the retail's down whilst the wholesale's up. And, we've seen this from covering sort of Ted Baker in the past and other similar strugglers. But when you see words like markdowns, that's not good either. And it does suggest the quality of the brand might be decreasing. I think the main issue for me, it is cheap, especially for a US listed company, but you go and look at the brands they've got, and it's basically just Guess. And I don't know what Louis Vuitton's trading at the minute, maybe like 20 times earnings, something. I'm just guessing, but I probably would rather pay double for Louis Vuitton because you're getting such so many quality brands. The growth figures are so much better. I think Guess is so cheap, there's potentially some value in there, especially if they can keep getting the licensing up. And ultimately, revenue was actually up. So they're not terrible results. And they're probably quite good given how cheap it is, but it's just not. There's just other businesses in the industry I'd rather own, even if they are priced higher. What about you, John?
Similar. I'm not convinced by the brands, so even though it is cheap, I wouldn't be going near it. And like you say, LVMH, I would absolutely be prepared to pay up for if I were looking, putting it side by side with the Guess.
So then, of the 6 businesses we've covered this week, Prudential, Direct Line, Next, Trustpilot, JD Wetherspoon, and Guess, which do you like the most and which do you like the least?
I would probably say Next would be my first choice, and probably go with Guess last, actually.
So I think for me, Next is an easy first choice. Last is a bit harder. I think I'd probably go with Prudential or Direct Line. Probably both of them, just because they just go in the too hard pile for me. I don't like insurers, so they'd probably go in for that. Yeah.
Okay. Well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.